Everyone says the QQQ is the best tech ETF, the easiest way to invest in future of technology. But what if I told you the numbers for the QQQ tell a completely different story? Behind that shiny performance, the QQQ has a couple serious red flags and things that could cost you returns and increase your risk without even realizing it. So before you buy another share, before you continue to invest, let's break down the QQQ and see if it really deserves that reputation of the king of ETFs when it comes to tech. Welcome back to the channel, guys. I'm Dennis. I help everyday investors make sure we're investing and making confident decisions when it comes to finances. And today we're going to be diving into the most popular ETF in the world, which is the Invesco QQQ. If you have caught some of the commercials, they are really driven and really focused on tech. It is recommended everywhere. When you look at finance videos, when you look at investment blogs, maybe even your own portfolio, like I have it in mine, it is often labeled as the best way to invest in technology. But here's the truth. When we start breaking down the actual structure, concentration of this QQQ fund and the performance data really doesn't hold up like we see in those headlines. So what exactly is the QQQ? Now, if you're unfamiliar in this, let's break it down. This tracks the NASDAQ 100, the 100 largest non-financial companies listed on the NASDAQ. So think about that, guys. We have 100 companies that is built of the QQQ. It excludes all of the financial companies, so they are not going to be included, which means when we look at Microsoft, Nvidia, Amazon, Meta, Apple, these are some of the huge tech companies. Sounds absolutely great, right? Great, strong growth, good names, people you know, places you know, huge profits. But there's one problem when it comes to the QQQ, that the same 5 or 6 stocks dominate almost 50% of this ETF. So again, when you start thinking about even the top 10 companies within here are holding a majority, meaning the other 90 companies within the QQQ almost have no presence at all. And this is going to continue if big tech really does continue like Nvidia, $5 trillion, $7 trillion, $10 trillion. They're going to essentially push into a smaller margin. And this is the same problem that we're seeing with the S&P 500. So while the QQQ holds around 100 companies on paper, you're actually exposed to very few in a very large amount. Those mega caps really drive a majority of the return. And of course, this really gives up the myth of diversification. This is one of the misconceptions. When you look at QQQ, think that it has diversification. NASDAQ 100, you're going to be there, but it is super concentrated, not just one company, but by the style and the sector which is built. Half of QQQ is technology. Another large slice of this is communication, consumer discretionary, which are 2. So if tech has a bad years, the QQQ is going to get crushed because there is not much of alliance on everything else. So you're putting all of your eggs in one very shiny tech basket. And unfortunately, it's great when it's going up like we're seeing right now. If there is a downturn, which people are kind of anticipating in 2026, this ETF could get wrecked. Now, historically, QQQ has delivered amazing returns during the tech boom. When you look at 2010 and even early 2020, downturns hit much harder when it comes to the overall portfolio. For example, during market correction or interest rate spikes, QQQ has dropped 30 to 40%, while the S&P 500 has dropped 10 to 15%. So you can kind of see where the focus, where the sector focus, and where the volatility come in. And it's not just the volatility. When we start looking at the QQQ, it is often higher than the overall market, which means you're paying a premium for growth because it is a little bit more expensive, which is, of course, fine when the market is growing. Very dangerous if growth slows. If we see a pullback, if we see an AI bubble, it could get, again, kind of crushed. Then we look at the structure of the QQQ, technical, and really the investment trust doesn't really give a lot of dividends. So you're not getting a lot of money back from those tech companies and can't lend securities to offset the expenses over a long period of time. It can be slightly less efficient than most of the modern ETFs that we see. So looking at better options, what should we do if we believe in tech? We don't want as much risk. We don't want as much exposure when it comes to the QQQ. Looking at blending the QQQ with something in a broader market. Now you're looking at the VTI or the VOO. You're keeping a little bit more concentration and still mitigating a lot of the risk. And again, when we start looking at the VTI and the VOO, a lot of people do have those concentration concerns that we see with the QQQ because of those heavy tech. Consider more specialized. If you're looking to get out of it, you could go into something like innovation, semiconductors, AI. cybersecurity as a very small part of your portfolio. We've talked about this before. When you think of the foundation, the VTI or the VOO, then you have some exposure to tech, but you don't want to overexpose yourself. And if you're looking to kind of play that pure tech, we have the Van Eck Semiconductor Fund. There are, QTUM if you're interested in getting into quantum computing. There's a lot of funds that are a lot more specific in building out exactly what you're looking for, and it builds a list and really a small part of your portfolio. We're talking about 3 to 5% having exposure in there. Now, if you're looking for weight or some ETFs that have equal weighting, broader diversification gives you a little bit more of a kind of a diversification in there, where equal weighting means that every company, all of those 100 NASDAQ companies are equally weighted versus having the market weight cap of being NVIDIA being very, very high, and those top 5 companies being a majority of what we see within the QQQ. And always remember, past performance within these is not guaranteed. The tech leaders of today might get absolutely demolished with new technology that is coming out in the future. So, of course, when we look at the big picture, the end of the day, QQQ is a good investment. It's not bad, a little bit misunderstood. When people think that they're investing into technology and it is the best way to invest in technology itself, it's a great momentum play when tech is going up. Very, very risky if there is a market shift, if we start seeing a lot more move into the value ETFs or a lot of a pullback or an AI bubble. Again, people could get absolutely crushed. So talking about this ETF as being the best tech ETF on the market, super simplifying things. Now, it's the biggest, it is the most famous, it is the most marketed, maybe the easiest to trade, but for long-term stability and of course diversification, this is not the ETF that you're going to have. Now, investing, of course, is not about chasing what is exactly popular. It's about understanding exactly how this is going to fit into your portfolio. And like I had said earlier, I do hold the QQQ in my portfolio. It is roughly, and I believe we have it at about 20 or 30% of the portfolio. Big bulk and the biggest holdings that I do have is in the VOO. And you'll also notice, though, when you look at the VOO and you do a comparison to the QQQ, there is a lot of tech overlap. That is, again, a very good thing to consider, where if you had a larger portion of the VOO, might not be as tech heavy as we see at QQQ, but it still does have a very high concentration on the market weighted cap. That's where even holding like a QQQ, you could put a VTV or a value ETF in there versus having the QQQ. Now, also remember, there is the VUG. Now, when we start looking over an extended amount of time, the VUG seems to be a lot more growth focused, a lot more tech focused, and it has been outperforming the QQQ on the 1 year, the 5 year, and the 10 year. So if you're looking for a little bit more of that pure play into tech itself, VUG is a good alternative. So of course, guys, QQQ can be very powerful in a portfolio. You have to know the strengths, you have to know the weaknesses when it comes to this ETF. If you're okay with a large volatility and believe in the large cap dominance that we're seeing within the next decade, QQQ might make sense in your portfolio. But if you want that broader exposure, if you're looking for small caps or you want more balance, there are better suited ETFs out there. The key is to not really follow the hype, follow the data, see the numbers, know exactly how you're investing and what. And because sometimes they say it is the best ETF, it is only the best for marketing. It might not be the best for your money. So if this video helped you with the QQQ, like breaking them down, hit that like button, subscribe to the channel. Really does help out the channel itself. Now, do you think the QQQ, as it is marketed, is the best tech ETF investment? Is it really overrated when it comes to building? And of course, like I said, don't forget to subscribe to the channel. We're going to break down a lot more ETFs, and I'll catch you in the next video.